Hello and welcome to the Investing with IBD podcast. It's Justin Nielsen here, your host. It's December 21st, 2022. We're at the tail end of what has been a really rough year. And joining me as always is Arusha Pierce. He's an O'Neill Global Advisors portfolio manager. How are you doing, Arusha?
I'm doing well, Justin, and I'm very excited for the two guests that are on today.
I am too. It's like we've got two legends of Wall Street. Of course, we're going to be welcoming back to the show Tom Dorsey. He was the founder of Dorsey Wright, which has been now bought by NASDAQ. He literally wrote a book on point and figure charts, really popularized that method of analysis. So welcome back to the show, Tom. How are you?
Thank you so much. Yeah, it's great. Great to be here.
Awesome to have you. And we're also joined by Ralph Acampora. Now, Ralph is a legend in his own right. This is one of the co-founders of the Chartered Market Technician Association. And, you know, he's known as kind of the godfather of technical analysis. So he's been at it for a while. So we can't wait to hear some of his stories. Welcome to the show, Ralph. How are you?
I'm fine, Justin. Thank you for inviting me and Tom.
Well, it's a pleasure to have you both, and I know that Ralph, you're dealing with some weather issues, but you look great right now. 8 inches of snow, negative 20 degrees. I live in Southern California, so that's completely foreign to me. I don't even know what that means.
You look over my right shoulder, you'll see the window behind me. It's all white out there.
Oh, I thought that was a painting. I had no idea because
I'm on a lake.
Wow.
Okay, very nice. Well, let's go ahead and get started. You know, Tom, we've kind of heard from Tom a little bit about his background last time he was on the podcast, but Ralph, maybe tell us a little bit about how you got started and why technical analysis. What was it about technical analysis that spoke to you so much?
Well, it's a long story, but in 1967, I unfortunately had a very serious automobile accident, and that changed my life. And when I was in the hospital, my father's very good friend was a Wall Street executive, actually. And I told him that I enjoyed reading the Wall Street Journal and Forbes magazine. And he said, "Oh, that's research. I'll get you a job." He couldn't get me a job because I didn't have an MBA. And then I saw an ad in the paper that said junior analysts wanted no experience necessary. I said, "Wow, that's my job." You know, I was on crutches and I ran over, and I think the guy was afraid I was going to hit him with my crutch. I was so excited about this job. I said, "I wash windows, do floors," and and the guy backed away and he said, all right. He hands me this book. He said, "You read this book over the weekend. Come in, you got a job Monday." That book changed my life.
And what was that book, Ralph?
Technical Analysis of the Stock Market by Edwards and McGee. That was the Bible in those days.
Right.
And I thoroughly enjoyed it. You know what it made me and everybody else do? It made us follow prices. And all of a sudden, if I could identify an uptrend or a downtrend, I had an opinion. And here was a guy that had absolutely no background. All of a sudden, I could tell you what I thought about IBM and gold and, whatever. And I said, wow, this is cool stuff. That's how it started.
Yeah, that's awesome. And now, Tom, of course, one of the things that really spoke to you, you kind of often refer to it as like your message from God when you, looked a little bit at the point and figure system. And again, it really came down to price for you, right?
It did, because I have a degree in economics, and probably the most important courses I had in college, and I could have stopped right there, was Econ 101 and Statistics 101. Those two things were the most important courses I had in college and stuck with me the rest of my life. The Econ 101, the supply and demand, the irrefutable law of supply and demand, stuck with me. And when I started this business Ralphie and I, we got over 100 years together in this business. I mean, once we're gone, there's not many people that can go back 100 years. Right. I mean, between the two of us.
Right.
Yes. Thank you.
Yeah. Good that you didn't put that all on Ralph himself.
Yeah. Ralph's not that old. He's still a young man.
Yeah.
You're the puppy. I guess.
That's right. And I'm 75. I started at Merrill Lynch back in 1974. And I first applied there and they weren't hiring anyone because it was early 74 and people had just been wiped out through 73, 74 bear markets. And here I was, a 20-something kid, just came back from training school at Merrill Lynch, and I'm here to save everybody. And nobody ever even told me it was a bear market. I had no idea. I'm 20 something. I'm going to Merrill Lynch training school learning how to sell.
Yeah.
So I come back to Merrill Lynch every day and I get on the phone and I would say, "Good morning, Mr. Jones." I said, say this 100 times a day. "My name's Tommy Dorsey. My company's Merrill Lynch, Pierce, Fenner, and Smith. The reason I called is twofold. First, I'd like to introduce myself. And second, I'd like to avail the services of my firm to you. Do you invest?" Open-ended question. Then they will come back to me and say, "Mr. Dorsey, I don't want to become acquainted with you. You can go to hell." Another person, lady I'm talking to, she says, "Oh, you're a stockbroker." Well, the last one I had made me just that, broker. And I'm starting to come to realization this is a tough business, prospecting people. And then I start getting the idea that it's just been wiped out. Nobody even told me that. And so at the end of the first year, I said, if I'm going to be successful in this business, I got to become an expert at something. And I looked around the office and nobody was doing options because they were new. They were only a year or so old.
Right.
And I said, options are going to be my direction. And options were. And I eventually got hired by Wheat First Securities to start and manage their first option strategy department. So here's where my life changes. First person I hire, Steve Kane was his name, wonderful, wonderful young man from North Carolina, brings this book with him right here. It's called The 3-Point Reversal Method of Point and Figure Stock Market Trading. This one is $7.95. His was $2.95 that he gave me. So you can see what's happened with inflation.
Yeah.
But as I read this book and I read the first paragraph of the introduction, and it brought me back to economics 101. And it's talking about that stocks don't go up unless there are more buyers and sellers willing to sell. And I say, hey, I get that.
Yeah.
Next thing I know, after this one paragraph right here, my life changed. I looked over at this chart on the next page and there was no writing. It was a point and figure chart. And I said, that chart speaks to me. And here's why. I'm dyslexic. I couldn't read all my life. But the point and figure chart, when I looked at that, it spoke to me.
Yeah.
And I knew that moment, that night that I read that book, that the reason I'm here on earth was to teach my brothers and sisters this methodology as long as I'm alive. And that's exactly what I did. 9 years later, after running that department and learning everything I could about options, I started Dorsey Wright and Associates. Walked down the street with nothing and said, okay, now's the time. It's like you put a megaphone upside down on your face so that when you start with your program, you look to the end and say, this is where I have to put my resignation in and start my company. But right here, I can make mistakes. I can make mistakes in that. But as you come down there and as the years pass and you get to that end of that megaphone, you got to make your decision and move on it. And that's what I did.
So back in that time, right? So back in the 70s, when you're both well into technical analysis, was it accepted in the industry at that time? Ralph, we'll start with you. What was your experience that time?
I'm the right guy to ask because I was in the industry.
Yeah.
Okay. I was in New York as an analyst. And I met another young analyst, say Johnny Brooks was his name. I was in 1970, I was around 26, 27 years old. I think Brooksy was like 25, something like that. We were a couple of years different. And we were both junior analysts at the New York Society of Security Analysts. That's where all the analysts went. So you got to understand, years ago, corporate America, when they wanted to talk to Wall Street analysts, they actually came to Wall Street, came to that society, had a big luncheon, and the chairman of the company and the vice chairman and the CEO, CFO, whatever, would talk about their company. Wow. And the analysts would politely sit there, raise their hand, ask questions, go back to the report with their notes, go back to their company and write the reports on these companies. And Johnny and I were never allowed to go to these things because we were mere chartists and they looked down on us. Guys are looking at, they say we were in the back of the bus. Hell, we weren't even on the bus. And what really bothered Brooksy and I is that we realized that the different analyst group, like the chemical analysts and the drug analysts and the food analysts, would have separate meetings and they would talk about their industries and all. And then one day, Johnny and I decided to, gee, why don't technical analysts have meetings? And that's the beginning of a whole situation that I am so proud of, because it changed the world of technical analysis. That organization, the Market Technicians Association, was the original name. Yep. Now it's called the Chartered Market Technicians. We'll probably talk to that in a few minutes. CMT Association, it's called today. That brought technicians together. The first evening dinner meeting, I don't know if you know this, Tom, we had a guy by the name of Edson Gould, was our first speaker. Yeah, and no one at the time ever met him, but they knew his work. 3 Steps in the Stumble, and he had all sorts of indicators. Yeah. He was Anometrics, I think, was the company he wrote or worked for or owned or something. And I said, wow, this is interesting. Look at this, you know. And then we were talking to other Wall Street analysts, and it grew over the years. So when we started, we had to fight the system. You know, we weren't looked upon as a legitimate form of analysis. But as the years go by, we'll talk about this later, what happened when the Sarbanes-Oxley law came out. We'll talk about that later, 2004, how things changed again.
But I'll tell you what's on my mind, Ralph, is what you've done with the Market Technicians Association is you brought technical analysis up to an even level with the chartered market technician, chartered market analyst, with the fundamental guys. Yeah. You and Brooksy brought that up there, and I'll tell you what is the most important thing in the world, which what you did helped me along the way develop Dorsey Wright & Associates.
I'm glad to hear you say that, Tom. Seriously, that's great. So it did bring more credibility to you, right?
Absolutely. And you know, wow, with your partner, with John Brooks, I met him in Kuala Lumpur at the very first International Asian Technical Analysis Conference. And who do I run into? Your partner, John Brooks. And he and I were like, we stuck together like you wouldn't believe.
He was very.
So I got to know him well.
Yeah. He's a very powerful little guy. You know, you got to know him. He got you in his clutches. Yeah, and well, it was the time. You know, years ago, I love to tell this to the young people. I mean, they look at me and laugh when I tell. Years ago, when you got into the business, that bear market, wow, at 73, 74, that was the worst bear market since the crash in 1929. The crash in 1929, the Dow dropped 89%. That bear market that Tom was talking about, that was the Arab oil crisis. That Dow dropped 45%. You know. And, you know, I talking about point and figure, I worked for a guy by the name of Alan Shaw at that time, very well respected technician, great, wonderful man. And I remember him that when we had that little group of market analysts would meet, the technical analysts, and I told Alan, I said, geez, you know, I'm having a little trouble with these guys. We're disagreeing on the market. And Alan nailed the top of that bear market. I mean, there were so many tops, Tom, point and figure tops, because I kept the point and figure library going, and massive tops. And they started breaking down in price, but the volume guys were saying, oh, don't worry about those breakdowns. They're on light volume. And then I said, Alan said, remember, young man, bear markets start on light volume. They end on heavy volume.
I like that.
That's the greatest message I ever got. So point and figure, absolutely. You're absolutely right, Tom. That was the beginning of everything for me also.
Yeah, it's the only thing that made any sense to me, and I carried that through my whole career. And eventually what happened was NASDAQ found it necessary to buy a technical analysis company, and in particular point and figure technical analysis. So all of a sudden, a massive firm like NASDAQ buys a technical analysis company. We go from the back of the office to the front of the office. You know, when people walk in and say, where's the technician here? He's sitting in the back over there. Don't talk. He's got this.
You have to knock on the closet, huh?
He's got this nervous tick. You know, he don't like to talk to many people. He's in the back row. Where's the fundamental guy? He's in the front row. But all of a sudden, when NASDAQ bought Dorsey Wright, we went to the front row, and that's because of Ralph and developing that Market Technicians Association. That's it. That guy right there did it.
Yeah.
Yeah, well,
He got you on the bus, right?
I do have to say, because I am a CMT, Ralph, and
Yes.
I used to go to the Boston MTA meetings, 20 plus years ago, and I just remember being so excited that I could talk to other people who were into technical analysis.
Yes,
That's right.
So so it changed my life, and
in fact,
yet another one. So
in the
thank you.
early days of the Market Technicians Association, the guys in Boston, a fellow by the name of Bill Doan at Fidelity, Walt Deemer at Putnam, and Bill Diani at Wellington, and they had, to this day, Fidelity has an enormous chart room. It's absolutely fabulous.
Yeah.
And they were also part of the community. So it wasn't just New York centric. Now we're out in, we got California, up in Boston. And then years later, we moved down to Florida, and we had a seminar down there, and there were technicians down there. Lowry report. Remember the Lowry service?
Yep, absolutely.
Lowry, sure.
Yep.
Very famous. Yeah. And he didn't, we heard of each other, but we never met each other. But the MTA kept reaching out, and it's fabulous. It's just fabulous.
So Ralph, actually, maybe talk about like the CMT annual symposium, right? It's grown to this really big event. I mean, I was there a few years ago, and I got to speak at the event, and it was a massive crowd, and I was amazed at the people that I met there. They're top of the top people. Talk about just that growth, and that's where I met Tom. Yeah. Right. I mean,
and you've got the 50th anniversary coming up, right?
Yeah. Thank you very much for saying that, because I'm just going to give you a plug. April 26th and 28th of next year, you got to come. I mean, it's going to be just awesome. It's going to be in New York, and we're going to have everybody. We're trying to get the old technicians, God bless them, they're still alive, like Newton Zinder, Alan Shaw, Bob Farrell. Wow. It's going to be awesome. And just to share what had happened. But prior to that, and this is my interpretation, the most important date in modern technical analysis history is Friday, December 17, 2004, when myself and David Krell and Tom, a couple of other guys, we got together and we fought the Sarbanes-Oxley law that came out that year that said all analysts had to take the levels 1 and 2 of the CFA exam. I said, no, not me. I'm not a fundamentalist. I'm a technical analyst. And we fought, and my argument was, hey guys, I was talking to the lawyers. I said, test us. We want to be tested, but test us on our body of knowledge.
Right.
But that one of the lawyers jumps up and says, "Oh, Ralphie, we see you on television. You're a nice guy." And then he shoves a chart in my face. I mean, these are like rubber. I said, "Oh God, he's asking me a question." And he says, "What's fact on this chart?" And I look at it, and I said, "Price is a fact." His eyes got about this big. With my finger, I went like this to his chest. I said, "And earnings are an estimate. You never restate this chart." He said, "Good answer."
That's awesome.
That's excellent.
And 4 months later, March of 2005, we got approval. So that CMT exam is now equal to and relevant to the CFA.
Right.
Mm-hmm.
That to me was the ultimate, Tom?
Yeah.
I'm doing everything in the back of the bus. Now we're on the bus. In fact, we're even driving the darn bus.
We're driving the damn bus. That's exactly right.
That's awesome.
And that's the way it should be. I mean, they changed their fundamental analysis. Remember when they came up with pro forma?
Oh yeah.
That was like, okay, how do we keep this rally going? We don't have any more fundamentals that we can even talk about. We're going to come up with this new term, pro forma, which means nothing. But it's doing great in a pro forma basis. So let's keep the rally going. And I'll tell you, with the .com crash in 2000, I was mentioning to Arusha that what happened was you had dentists and doctors who gave up their practice to go rent a desk with a computer to trade the tech stocks.
Yeah.
And they eventually lost it all.
Well, when we come back, we're going to talk a little bit more about the timing in which both Tom and Ralph got started and some of the stories that they have from their years on Wall Street. Stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Okay, welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, and I'm always joined by Arusha Peiris, O'Neill Global Advisors Portfolio Manager, and we've got 2 special guests here, legends of Wall Street and technical analysis, Tom Dorsey and Ralph Acampora. So Ralph, at the break, you were telling us a really interesting story, and this was from a question from Tom, where he was saying, hey, tell him what you did on your Sundays as you were coming up in the field of technical analysis. So go ahead and share that story if you don't mind.
Well, I had an apartment, which was right in Lower Manhattan, because I always wanted to be close to the office. And so all the guys, the traders and the salespeople, and I worked for Prudential at the time. That incident happened. And they knew, and they would come to the apartment and whatever. But on weekends, I was by myself. And but there's a charting service called Mansfield at the time. And in fact, I think you still can get the service. And it was a weekly bar chart, and you had everything. I mean, all the New York, all the American, over-the-counter stuff. It was a real thick publication. And I didn't wait until they mailed it to me, because I would get it on Monday or Tuesday. It was too late. When I had it hand-delivered, I paid extra for it, hand-delivered to my house. I either get it on late Saturday afternoon or early Sunday morning. I definitely would have it. And what I would do is segregate hours on a Sunday afternoon. I would sit at my kitchen table. I could look out my window. I could almost touch the Statue of Liberty. I had a beautiful apartment in Lower Manhattan. And I'd sit there with my Mansfield going through it, and then a glass of Merlot. And I keep turning the pages and I keep drinking my Merlot. And after a while, I had a lot of very nice ideas.
How many glasses of Merlot were you into it before you finished that many charts?
Probably should have glasses or bottles. Yes. Anyway, Monday morning, of course, I'd have the conference call. Right? We always had a research conference call at 7 a.m. And I'd be there. And of course, Monday morning, to have fresh ideas for the sales force and the traders. And they loved it, because they would take those ideas and run with them. And when they found out that I was drinking the Merlot, they kept saying, "Go, keep drinking, Ralph, keep drinking." That's good. And then they started sending me cases of the stuff to the house. And when people said, "What are you doing on Sundays?" I said, "I'm eating my M&Ms."
Merlot and Mansfield, huh? Now, Tom, what about you? You kind of had your own process. I mean, when you first started out, started with your company, I mean, you didn't have that many of you. So how did you do your analysis?
Well, we started in 1987, and January 87. We had no computer. We had a Tandy 3000 computer. It's all we could afford, and that's in the Smithsonian Institute now. That doesn't even run anything. And you didn't have charting systems or no technology.
No.
Yeah. So we would update 2,500 stocks by hand every day. I had 5 analysts, and each one of them would take a 500 stock book and update it by hand. So looking at with a point and figure, you don't update every day like a bar chart.
Okay.
But you have to look at the price. Did it hit this or did it hit that? And I'm going to make O's or X's. And then after that day, you would give that 500 share book to the next analyst. So by the end of the week, every analyst had seen all 2,500 stocks. And that's where we got our ideas from every day. So when the analyst was looking at his 500 share stock, he came across a few things that, oh boy, these look fantastic. We're going to put these. This is going to be ideas. So all 5 of them, we would come up with the ideas and put them out that way. And it worked great. And finally, we got technology. I think it was around 1993, 94. We got the technology that could run all those stocks, run the computer program, update them every day. And it took me a lot to get those charts out of my analysts' hands. They didn't want to give it up.
They had their system down.
Want to give it up doing it by hand. But we had to. I mean, we had to move with technology.
Yeah.
So we were on the internet 1994. We were on the net in 94.
So Tom, you mentioned 1987. So
Yep.
I'll ask Ralph this. So Ralph, what are your experiences and memories from 1987, since that was such a significant time in the stock market?
Well, I don't have a very good memory on that. Let me put it this way. I don't want to remember.
Yeah, right.
Actually, I hate to tell this story because, well, it's the truth. I was on the cover of Barron's magazine about 2 weeks before the crash.
Wow.
I was on there with Bob Prechter, Elliott Wave guy, very important.
Yep.
Marty Zweig, who was on Wall Street Week. He had the put-call ratio and things like that. And they were actually using the phrase crash. And I was saying, well, I think we're going to have a little pullback. And needless to say, obviously, it was a massive decline. And I know Tom was pretty well prepared for that decline, if I'm not mistaken. And not that I couldn't see the decline coming, I didn't have the magnitude of the decline. You know, they said there's a decline coming in to calculate, especially that one. It was just a straight line down. So it was a hard call. That's my bad call. Later, hopefully you ask me about my good call.
Yeah, we'll make sure. Tom, why don't you talk about your 87 experience?
Yeah.
Well, 87 experience, that's when the company started in January of 1987. And we started with $90,000 borrowed from Dominic and Dominic in New York City, old line brokerage firm, and owed that back with interest in 1 year. And so we had nothing. You know, I had a pregnant wife, 2 young sons, and about to have my daughter in November of 1987.
Mm-hmm.
So when all of a sudden the crash of 87 happened, before it happened, we only knew one thing: the bullish percent index on point and figure charting. That was created by A.W. Cohen back in the 40s. And it was simply a calculation of the percentage of stocks on the New York Stock Exchange that were on point and figure buy signals. It's not price related, but it's point and figure related. So if you have a condition in which 70% of the stocks are on point and figure buy signals on the New York Stock Exchange, everyone's in that wants to be in.
Mm-hmm.
And that's where the risk begins to happen. And when you're at 30%, everyone is sold that wants to sell. If you haven't sold yet, your parents gave you a $2 stock that you have in your portfolio and you can't sell. It's Coca-Cola, $2. You know, so it was an interesting experience because we were option related. Watson, I ran the option department, and Watson was my right-hand man there at Wheat First Securities. All we knew was to hedge. And we wrote the report every day down to the crash of what to do to protect your portfolio. When that bullish percent had reversed twice, there was no question in our mind the downside was to play. We had no idea how bad it would get, but you had to play defense.
Yeah.
And the only way to play defense with us was selling calls, buying puts, doing various different strategies until we finally ran out of stuff to talk about. And that was about a week after that the crash happened. So the crash actually saved my company because it was the one time that we actually advertised what we had said. Here's what we said before the crash: save my company. Otherwise, option strategy companies were going down like you wouldn't believe.
Mm-hmm.
I mean, there was more lawsuits and things like that.
Wow.
The stuff that happened was just unbelievable.
And here you had this huge marketing opportunity because you could say, hey, here's what we said and here's what happened.
We protected.
Yeah. Like I told Arusha, I said, you know, what I used to do, I used to fly all the time.
Yeah.
And I'm in airports all the time. I used to put Dorsey Wright flyers in the stalls in the men's room. If you're going to sit there, you're going to read about Dorsey Wright.
Captive audience, right?
Yeah, it's just, you're the head of sales. I mean, you're in charge of sales, so I'm not going to waste that time, you know.
Well, I'm glad you used a flyer and didn't, you know, have a personal meeting.
Yeah, no, any stall was empty. I put the flyer in there and left.
Well, you know what, we got to give Ralph a chance to redeem himself. Yes. So Ralph, you know, what was your good call that you made?
That's great. I have to go back to a conversation I had in 1970 when we started the Market Technicians Association. It was the first evening meeting that we had. And I'm sitting next to, I talked about Johnny Brooks before, the co-founder with me. Well, Johnny and I were sitting on either side of an old gentleman by the name of Ken Ward. Ken Ward was the oldest living technician I ever met in my life. He was about 82, 83 years old. This is 1970. That meant that he lived through every bull and bear market in the 20th century. And he wrote about most of them. So I sat down. It was like me sitting next to Mickey Mantle. Oh boy, this is really exciting. For those who remember Mickey Mantle, the Yankee outfielder. Okay, all right, yeah, okay, just checking. I leaned over and I said, "Mr. Ward, sir, what was the most difficult market you ever had to live through and write about?" I said, "Oh, forgive me, that's a dumb question. It has to be the crash of '29." And with a grovelly voice, he leans over, and Johnny and I, the three of our heads are close to each other. And he leans over and he said, "Don't worry, young man." He said, "That wasn't the worst market." He said, we lost money, don't get me wrong, but the toughest market to call was the early 60s. I said, "But it went up." He said, "It sure did. And no one believed it. We kept saying it's overbought. We fought it all the way up. You go check the Wall Street Journal. You'll see me and Ralph Rottenham and all these other great technicians at the time. And we couldn't believe the strength." I never forgot that. In 1994, late 94, early 1995, the Dow was up like about 900 points without a correction. And here I am 25 years later, and this conversation is ringing in my head. You know what I did? Again, no computers in those days. I couldn't go online. So I went to the New York Public Library in Midtown Manhattan, and I coughed for a whole week, going through every Wall Street Journal. There were stacks of them. They had them. And I read every Wall Street Journal from 1960 to 1966. I did my research. I wanted to go through that period of time that he was talking about. And what I found that was interesting was actually a fundamental situation there, was low inflation, low interest rates. And that was the theme of my article. The Dow comes out. The article reads, the title of my report was Dow 7,000. And then Dow at the time was 3,800. And everybody thought I was out of my mind. Yeah. And fortunately, the firm allowed me to write it because they were saying, "This is crazy. What are you doing?" And they agreed. And I put the report out. By the way, it was a 58-page report with lots of charts in it and everything. And I was wrong. It didn't take 3 years. It did it in 2 years. And I have to thank, and to this day, I'm very humble, and I thank the MTA and this is that sharing that the whole organization is about. I mean, had I not had that conversation, I would never probably have written that letter.
And then you had a happy client too, right? Yeah, right, Ralph?
And Mansfield and Merlot's, and I kept raising my target, and I raised the next target to 10,000, and I caught the whole I caught the whole 90s period. And by the way, on the way up, we didn't know it was .com, this .com, that, but it became that at the latter period. And as Tom mentioned before, everybody got involved because it was easy. Yeah, it was, the market kept climbing, crazy. And that move from 7,000 to 10,000 was not, from my point of view, was not a fundamental call, which the first part was low inflation, low interest. From 7,000 to 10,000 was strictly momentum. Yeah. And that was technical analysis that helped me go that far.
Right.
Yeah. Interesting story. And thanks for asking, because I want other people to listen to that, because you'll have reasons and then you don't have reasons for moves, but you never fight the trend.
Right.
That's right. You can't. You
gotta go with the
Fed or the Fed.
Yes.
Yeah.
Or the Fed.
Or the Fed.
Yeah, I mean, you say low inflation, low interest rates. It reminds me of a time not too far back that we had, right? That really led to some powerful gains. So Tom,
you know what? Actually, let's ask them about 1982, right? Because that's been that obviously significant for us at O'Neill.
Yeah.
Right. Why don't you guys talk about 1982?
Well, let me talk about the years leading up to it. Now, I came into business 1967. The year before that, 1966, the Dow had the first time it hit 1,000 and then dropped 20%. And for the next 14, 15, 16 years, the Dow couldn't get above 1,000. And I had all these guys that I was working for, they had these long depressed faces. And I'm saying to myself, why did I get in this business? Everybody's so unhappy and mean and nasty and rah, rah. You know, the market go up for a year and then it go down for a year. And it was horrible. It was horrible. But in 1982, well, by the way, at that period of time, we look back now, we call it stagflation.
Right.
Okay. Prime rate was 21.5%. When I say that to the kids today, they look at me like I got a hole in my head. I bought that apartment that I was talking about. I paid 10% mortgage, and they kissed the bank, and they didn't charge me 12%. You know, and they're worried about the mortgage now being 6-7%. Give me a break. Come on.
Yeah, exactly.
Low inflation, man. And that's what happened in 82. They started to cut rates and started the whole period that maybe Tom could add to that too. I'm sure.
Yeah, what was your experience in 82 there, Tom?
Yeah, here's the thing that I'll never forget. The patterns that were developed by the great minds on point and figures back in the 30s and 80s, and even Charles Dow in the late 1800s.
Yeah.
These simple things they created, that New York Stock Exchange bullish percent, which is near and dear to my heart. That bullish percent in 1982 was going up to a particular level. I can't think exactly what it might have been, 34, something like that. And it hit that and fell back. And it hit that and fell back. And it hit that level and fell back. This is the bullish percent now. This is percent of stocks on the New York Stock Exchange that have point and figure buy signals. So it's not price related. Then it hits the fourth time and exceeds that level. And we went 180 into this market. That was the beginning of a 20-year bull market. By then, by the time that bullish percent gave a buy signal for the market itself, the small caps were already up 20%.
Yeah. Yeah.
You know, so
amazing.
It was, I'll never forget that time. And that was the beginning of a 20-year bull market. I mean, it was, we had tough times in between there.
Sure.
Overall, it reminds me of when my son came to my house a few years ago, and he said, I'm really worried about the market. And he said, my kids, et cetera, et cetera, et cetera. I said, Thomas, when I got in this business, the Dow Jones was 800.
Yeah.
I said, we wound down Vietnam. We've gone into all these Far Eastern places. We've started wars. We've gone through 9/11. We've had everything you can possibly happen. And the Dow Jones at 34,000. I said, what's up with that? So he said, then I guess in the S&P 500 we trust. And I had T-shirts made up with that. In the S&P 500 we trust.
Yeah, just that simple. Okay, well, when we come back, we're going to talk a little bit about the current market, some of the stocks that are maybe on your radar right now, and certainly get into some more stories. Stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Okay, welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, along with Arusha Pierce, who joins me every week from O'Neill Global Advisors Portfolio Management. And we also have Tom Dorsey from the Point and Figure Dorsey Wright operation from way back when, bought by NASDAQ not too long ago, and Ralph Acampora, the godfather of technical analysis. So let's get a little bit into the current market, but also some parallels and what's kind of the same, what's different. So Tom, why don't you start us out? What's your take on the current market as we've got the high inflation, interest rates on the rise, a bear market for most of 2022. What's your analysis here?
Well, those kinds of things, we've been there before.
Yeah.
We've already seen that with the recessions. That's exactly the type of things that happen. But when you have this now with the invasion of Ukraine, with Putin talking about nuclear war, with recession on the wings. I mean, you could just line up all kinds of different things that could happen to make this really bad. By the same token, the more you talk about things being bad, it will come to an end. This too shall pass.
Mm-hmm.
And what it has done for me, though, when I turned 70, while back, I come to the realization that most people today that have money are interested in having their pie out of the sky and on the table.
Mm-hmm.
And I manage probably 20 accounts of friends and family that charge nothing to do this. And the first question I ask them, and these are small accounts, do you want your pie in the sky or do you want it on the table? They said, what do you mean? Are you interested in the technology types of stocks? You want Amazon, Apple, computer, all these types? Or would you prefer to have something less volatile, higher yield? And the people in their 70s say, boy, nobody ever told me anything about that. That's what I want.
Mm-hmm.
I want my pie on the table. So closed-end funds all of a sudden became an interesting play with me because these ladies who own big BIGG whale, WHALE.com, they're the best at this. And they came and asked me if I could help them market this to advisors. I said, sure, I'd be happy to do it. But I had to learn it to do that. As I learned it, I came to the realization this is my way too. Hell, I'm mid 70s. I'm considered elderly, whatever. I mean, with Ralphie, I don't even know where he is. I mean,
I'm out here.
You know he can hear you, right, Tom? You know, I mean, he's.
But the thing with the closed-end funds are, you can chart them, and they're managed by people. Let's say they're a particular oil company or oil infrastructure. These are the best managers in that, and they're yielding 8, 9, and 10%.
Mm-hmm.
And that's what people are interested in. When you can get a check a month for something like that, and all of a sudden you're in your 70s, rather than having the wild technology type of stocks, say, what am I going to do with that? These things are going up and down and up and down and up and down. I want something that's stable and send me a check every month.
Mm-hmm.
I want the corn that's in the silo. I'm not so interested in my farm and whether the price goes up or down or whatnot. I want the rent. Keep paying me that rent. And that's been the key for me. So I do a lot in my own portfolios with closed-end funds. However, I'll take it a step further and margin that portfolio and do naked straddles and strangles, which is probably not a good idea, especially for anyone, unless you're well-versed in options. But that's the kind of thing that I do now, and it's low volatility, high yield. And when that check comes in every month, that's income that's passive that you can use.
Right. Whether it's for lifestyle or just kind of the luxuries that you might want to.
Precisely. Well, I have one couple, and they have a small account with me, and this account has been able to generate $20,000 a year to them. This is meaningful. Now they're able to go visit their son in Ibiza for 2 weeks a year. And the husband, who's 6'5", can fly business class and lay out flat on the plane. These are the things that are important to people in their 70s and 80s, Ralph.
Yeah.
You know, that you can have a better lifestyle rather than building up a portfolio full of Apple and Amazon and whatnot. What are you going to do with that? Yeah. Give it to your kids when it's done. So what? Enjoy yourself now.
Yeah.
Ralph, so what are your thoughts on the market just from a general point of view?
Tom was talking about strategy and investing and all. I'll talk about the overall market.
Yeah.
Well, obviously, this year has been a terrible year. You know, most stocks went down. You know, you could say it's a bear market, 20%, etc. My red line, okay, I'm being very technical for a second. The support level for me and most important date was October 13th. We had that huge, that was a phenomenal reversal day.
Right.
The Dow was somewhere around 28,000, 29,000. I don't know the exact number. I get it for you if you want. And the S&P. And so I say I was very enthusiastic about that low. Not that I was immediately a bull, but we had a nice run, 20% rally off that low, November, December. And the last couple of days, last week, we got hit with a karate chop. So we're going to get this back and forth. I look over my shoulder just at the TV now. The market had another nice, great day. It came out of nowhere. So the volatility that we're in, I think will continue, because what Tom was alluded to before, between all the cross currents, between there's a war coming, there is a war with the Ukrainians, and the back and forth with the Democrats and the Republicans. I mean, this country is so split. It's sickening. I put the TV on mute, not to get aggravated. And it's not a political statement on my part. I'm an American who's upset about our politicians who can't agree on the weather, these jerks.
Right.
And sorry for getting upset, but I am a little bit more positive. And as long as that October 13th level holds, I think we're going to bounce around here. It looks like from today anyway, that maybe we're going to get our Santa Claus rally, which doesn't mean very much. I mean, it makes you feel good. It goes into the first couple of days of the new year. Could we have another decline, a 10% decline, go down to test the low? Absolutely. Because you still got the Fed out there. But I got to say, Joel Powell, he was pretty tough the last time he got on the TV. And but the market's absorbing that.
Yeah.
I think the market is taking a punch in the nose, and it's holding. So I'm in the camp of saying, be very, very selective, because as Tom pointed out, the technologies, unless you're willing to take a risk, they don't look like they've bottomed out yet.
Mm-hmm.
But when it comes to, like, if you're a little, I won't say aggressive, but if you're willing to step up a little bit, the healthcare, I like, consumer staples, I like, industrials, I like Boeing and things like that. You can nibble a little bit. So I'm not bearish. There's my red line. You take that out on the downside, and I'm history, then the bear market has another leg down. But other than that, volatility here, slowly market trying to bottom.
Well, and it sounds like some of those areas that you're talking about, staples, industrials, a little bit more on the defensive side.
Yeah. Oh, yeah.
Well, things people need.
Yeah.
Things
right.
people need.
Mm-hmm.
Yeah. Well, go ahead, Tom.
I'm sorry, but one way that people can play this type of market where it's very uncertain is with the option business.
Mm-hmm.
And there's nothing wrong with buying one call on Apple Computer or whatever. But the key to option trading is don't trade them. Buy a call, hold it till expiration. That's Jim Yates's, my old mentor, Jim Yates, the greatest guy in options. Hold the call till expiration. He's dead right. And that takes the emotion out of it. And you can diversify your portfolio with a small amount of money. Like Ralph, you say you have a point at what you're willing to stop.
Mm-hmm.
Then that's all you invest is what you're willing to stop, but do it in options and say, okay, if they go to hell in a handbasket, then I've managed my portfolio properly.
Hey, Tom, we finally agree on something. Yeah.
We always agree, Ralph. I mean,
well, and you know what? Another thing is, I know that Tom, last time we had you on, that bullish percentage was starting to turn around, and I think just maybe a day or two after you were on our show, I think you got that signal, the full bullish signal.
That's right.
Yeah, that was
it happened October 5th.
Right.
Yeah,
so a little bit before that October 13th day,
the
CPI report that Ralph was referring to.
Yep.
Very nice. Very nice.
But it reversed up, but 2 days ago it reversed down. Well, now we're back in what is called in point and figure parlance bear confirmed.
Mm-hmm.
So I have to believe that the downside is the problem here, not the upside.
Okay.
Mm-hmm.
I
see that turn.
I like to just take the opposite of that and say, I think we're going to have a year-end rally, and let's see after that.
Mm-hmm. Yeah.
Yeah. Well,
good.
Well, we got another week for year-end.
Yeah. So we've got our calls out. So we'll have to have you both on again to say, okay, who made the good call, who made the bad call.
Well, yeah, you got to maybe after the first quarter of next year.
Yeah. Okay.
Oh,
Perfect.
Yeah, I'm not
Yeah, get us a
making a
ticket
call.
for
I'm
you.
just saying if you're going to
Yeah,
invest,
yeah,
maybe the best way to do it
yeah.
is take as little
Yes.
risk
No,
as
he's
possible, but
right.
also have the potential to
He's
make
right.
that gain.
Yeah.
So if I'm a 500 share buyer of a particular stock, I might buy 5 at the money calls and hold them till expiration. You
Hmm.
cannot sell them.
Hmm. Yeah.
I hate to say it, but Tom's right.
Well, but before we kind of close out, I think again one of the things that both of you offer is that there's certainly with your years of experience, again, having gone through it when Ralph, as you put it, where you didn't have a seat on the bus to really
Yeah.
kind of making a name for technical analysis and
And
everything.
driving the bus. Now he
Driving
drives
the bus, exactly. So maybe we start with you, Tom. What kind of parting advice do you have for people that I mean, we had a big inflow of new investors, once we had that COVID crash and people were at home for a long time, I mean, everyone just saw this huge inflow of new investors. So you have all these folks that in 2020 were thinking how great stuff is. Now they've experienced a bear market and maybe they're changing their tune a little bit. What's your advice for all of these investors of the next generation?
I have simple advice, and it's going to sound self-serving. Get a copy of my book and read it cover to cover,
Mm-hmm.
and implement that technical analysis strategies, and you're going to be fine.
Mm-hmm.
That's great. Yes.
That's
Very
it.
simple.
And Ralph's got a book out too. Read Ralph's book. I mean,
Okay.
That was about the mega market, but that's long gone. That's past. It's dated book.
But history is important to learn from history and stuff like that. So I still think
Absolutely.
sometimes it's great to read about what was going on. And as you pointed out earlier from Mr. Ward, hey,
Right.
this guy imparted you with some wisdom that you didn't use immediately, but 25 years after you got that little bit of wisdom, you knew what to do with it. So what about you, Ralph? What kind of parting words of advice do you have for?
Well, that's a great question. I love that question. I'm usually asked that question slightly differently. Say, hey, Ralph, you've been doing this for over 50 years. Has anything changed?
Yeah.
And my answer is no. You still have buyers and sellers.
That's right.
Keep it simple. We have all these wonderful indicators, Fibonacci, Liberace numbers. We got the moving averages and RSIs and all this sort of stuff. And I love them and I use them, but I only own price. I don't own the indicator. Okay.
Mm-hmm.
And if you could draw a straight line, trend's your friend.
Mm-hmm.
I mean, I know it sounds simple and I'm downplaying it, but I really mean it. And Tom refers to the supply and demand, the laws of supply and that's basically what we're talking about. So has the psychology of investors changed? The behavioral finance? No. Charlie Dow in his editorials wrote about fear and greed in the late 1800s.
Yeah.
And it's still today. Come on, we're human beings. It's money, we worry about our money. And then we go crazy and speculate like nuts.
Well, think about the tulip craze in the 600s, and I mean, or 1600s. I mean, it just never ends. It just never ends.
Yeah. So be kind to yourself. Trend's your friend. Buy and hold if it's going up. If it's going down, I wouldn't buy it with your money.
and what Ralph just said is exactly that paragraph that I read that changed my life profoundly. Yeah. What he just said about supply and demand and whatnot was in that paragraph that changed my whole life. I knew why I was put here on earth, what I had to do, and what Ralph just said was that paragraph.
Wow.
Yeah.
I didn't write that paragraph.
Well, and you really summed it up with that whole keep it simple. It's very easy to make this a complicated game with, the macroeconomic side, the technical, the indicators. But at the end of the day,
that's why people who follow it love it so much. We're passionate about it.
Right.
Because it's given us the ability to have an opinion. And we know if you're doing it right, we know when we have to change. And that's the optimum word in this business. Change.
Yeah.
When
Change,
it's
that's right.
wrong, risk management, darn it.
That's the
Yes.
name of the game right there.
Yes.
I mean, like what, a year ago in November, all of a sudden we started seeing something was off with the market, and the risk management helped us get out.
Yes.
And you didn't argue with the market. You didn't let the macro get you, keep you in. You just listened to price and followed the trend. And when the trend was down, you just got out and protected yourself.
Yeah.
Mm-hmm. Well, I got to thank you both for again sharing your knowledge with all of our listeners, and this has been an awesome time. I really appreciate all the stories. You both approach it with such humor and grace, and just a wealth of knowledge. So thank
Justin,
you both so much for sharing.
And Justin, Ralph, why don't you give that plug one more time for the CMT annual?
Oh yeah, we got to let Ralph do that. Yeah, because
yes,
Arush is going to be there. I can already see it in his face.
Next April next year, in New York City, the CMT Association is going to celebrate their 50th anniversary. I can't wait just to be with all the people that are going to be there. There's going to be lots of us old timers, and there'll be a lot of young people there, and just sharing the ideas and just wonderful, what we've done to date. But that's just the beginning, because, a lot of us, obviously people who listen to the show or broadcast, have an interest in the subject. But just think about it. How many people outside of this group really understand technical analysis? They don't. Yeah. They have to be educated. And that's what the CMT is all about. Come on, guys. More to learn. Right. Got to keep going. We need another 50 years of education.
And so is this open to anyone?
Anyone, absolutely. Come on.
Okay, perfect.
Justin,
okay.
What you guys need to do, have Ralph and I back on when we hit 95.
Yeah.
Perfect. Okay, it's a date. It's a date.
Well, I like round numbers. I'm going for 100.
Okay. well, we'll start with 90. We'll start with 90, and then we'll have the follow-up at 100. How about that?
I'll be there.
Okay, awesome.
There you go.
Okay, well, you take care.
You and I can have that Merlot, Tom.
Yes, yeah, Merlot for everybody.
Yeah.
Maybe we'll pull out the Mansfield charts too.
Thank you guys.
Or we can add another M and pull up the Market Smith charts. Yeah. So hey, we'll Merlot and Market Smith.
Yeah, there you go.
Okay, perfect. Thanks so much, guys. And on our show, on our show next week, we're actually going to be taking the week off between Christmas and New Year's. So it's going to be based on what you voted for. Lots of excitement about Jim Ropel's episode that he had. So we're going to do a replay of that. So hope you join us and remember the words of wisdom that Jim Ropel shared with us earlier in the year. But thanks for watching this episode, and we'll see you next time. Have a great holiday, everybody. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.